Hello, everyone. This is Sebastian McMahon from IA Financial Group, and I'm back with the weekly economic review for the week ending August 22nd, 2025. It's been a few weeks since the last review. Since then, of course, Liberation Day 2.0 tariffs have been put in place. This is the world that we live in. We've seen some profit taking in technology names, likely not related to tariffs, more of we've had such a strong run here that at some point there's some profit taking, some rotation here. Expectations towards the next Fed decision also have contributed to pushing the markets higher, because markets is expecting a few more cuts than we do, at least. And now that this is getting revised a little bit, well, the markets have corrected somewhat, a few percentage points, especially in tech and in NASDAQ. So just a disclaimer, I am recording this before Mr. Powell speaks at Jackson Hole. We're not expecting something, market moving. We're expecting him to focus on the framework of the Fed, and we're expecting him also to, let's say, repeat some of the messages that he sent in late July, when he said that you must look at the unemployment rate and measures of slack in the labor market and not look at the headline numbers. And the slack remains, let's say, below average. So the labor market remains somewhat tight based on the measures that we typically follow. And inflationary pressures, of course, are starting to take shape. And this is the topic of this review, how the sequence is starting to unfold. There's no pressure yet on CPI, but it's likely coming. So the topic is the life of a central banker, just to show that it's a tough job these days with everything that's going on. And let's also factor in the political pressure in the US, which is making central bankers' jobs quite difficult. But we won't dig too much into that one. So let's look at this week's markets at the close on a Thursday. Negative for bonds. The TSX and EFI were able to add to their yearly totals this week. The pullback was mostly in the US. NASDAQ, S&P 500 down as much as 2.4% for the NASDAQ. Year to date in Canadian dollars, picture remains the same. You were better off investing in Europe, close to 20%, then TSX and emerging markets about 15%, and in the US with 5 to 6% returns. Price of oil positive on the week, but at the low end of the range, close to $60. USD was stronger this week. We still have a long-term bearish view on the USD, but these things don't go in a straight line. The adjustment to the momentum, to the sentiment, to the consensus, to the positioning, all of that since the beginning of the year was a very solid vector for us. We had a negative view in the USD. We reaped the rewards from there, but we did close temporarily the position recently because we feel that now the market is kind of digesting all of this, trading a bit more on the Fed. We still think that over the next 2 to 3 years, we'll have another down leg on the USD, but just sharpening our pencils and making sure that we have our thesis right and the right entry point. But we still think that there's more downside for the USD here, but we could have some consolidation. Price of gold, still one of our trades that we have in place. Not going anywhere right now, but we still see this as an interesting thesis as central banks are still accumulating gold in their reserves. So this is the picture for the week. Now, I think since early February, I've had an update on tariffs page, which was usually like headlines because Trump says this, does this, someone says something else. For the first time since February now, I'm showing data here. The gross custom duties in the US, we have the data for July. So this is pre-Liberation Day 2.0. And the average monthly pull from the customs duties went from $8 billion early this year to now $28 billion. So that's plus 20. So that's a tax of about $20 billion on the US importers. And this is as of July. As you see on the right, the effective tariff rate in July had jumped to 10%. Now we're looking more at 15-20% in August and beyond. So the pull that we see on the left could double over the next few months. So this is what we have right now. So the government in the US is really taxing its production sector. And this is the sequence is starting to take shape on how this will lead to inflation. So if we go into that sequence, so how tariffs will lead to inflation, here you have two charts. On the left, you have import prices, and it's very convenient the way this series is built on the left-hand side of your screen here, because the BLS, the statistical agency, what they do is that they strip out any impact from taxes and tariffs. So this is really the prices that U.S. businesses are paying to foreign exporters. And as you can see in this chart, there is no concession yet that is made by foreign exporters. So when Donald Trump said that, exporters will pay for that because they will lower their price for the privilege of selling to the U.S. Well, we're not seeing it yet. We are starting to see it somewhat in Canada. But if you aggregate every country and every sector together, we don't see it yet. On the right-hand side, what you see is that import prices, this is the inflation year over year, with and without the tariff impact. So without a tariff impact, import prices have been pretty much flat year over year. But if you factor in the tariffs, now you see that it's a rise of 5%. So the cost of importers is rising by 5% when you factor in the tariffs. And we could see an acceleration of that, of course, over the next few months as the data comes in. Now, we have also had a very interesting PPI print in August for the month of July. PPI is the producer price inflation. So it's a measure of the cost of producers of doing business before they sell anything to consumers. And month over month, the chart on the left, you see that month over month, you've seen this spike to 0.9% on a month. So close to 1% inflation on the month. We've seen, worse than that in 2021, 2022, but see this maybe as a first sign that, okay, tariffs now are starting to show up in the data, because remember that early this year, the first quarter, US businesses started importing much more just to stock up on inventories to just smooth out the effect. But now we're hearing anecdotal evidence that the inventory levels have dried out, and now they have to import again, and that means that now they're paying the tariffs. And the chart on the right shows that PPI versus CPI, so inflation at the business level versus at the consumer level, they tend to go hand in hand, but the PPI tends to come a little bit earlier. The changes come earlier than on the CPI. So the businesses, they take a hit and then they pass on the bill to consumers. So now, it's reasonable to expect that if the PPI spikes, then the CPI should follow. So the sequence is very early. We'll be following that for sure over the next few months with you. But this is how it works, and it's starting to take shape. So where should the Fed go from now? Well, here I brought something which is the Taylor rule. If you're not an economist, just know that the Taylor rule is a model that was built by an economist, an academic, that kind of made a guide for how the Fed should behave. And the Fed has adopted that model, and there are many variations on this model from research from the Fed. So, if it interests you, there's a little box on the bottom left that gives you a bit more info. But just take this kind of as a GPS for what the Fed should go, which route should it take. So the dark blue line is the actual rate from the Fed, the Fed rate in the US. Now we're at 4.5%. And all of the other lines are variations of the Taylor rule, which suggests that the rate right now should be, in the most optimistic case, at 4.5%, so exactly where we are, or it should even be higher than at 4.5%. So if the Fed follows its framework, it should not be rushing into cutting rates now. In fact, it should maybe be thinking if rates are not too low. And when you look at market valuations, when you look at the behavior of the economy, there's no signs here that monetary policy is too tight. I mean, it's a fallacy to say that the data is showing that monetary policy is too tight. It could be easier to make the case that the monetary policy is a bit too easy right now. So now the Fed, there's political pressures at play. Mr. Powell is leaving in May of 2026. They need to be careful not to send a signal to the market that they have lost their independence. If they're cutting, they need to be cutting for good reasons. But markets are asking for cuts, so the Fed can be sensitive to that. You don't want to shock the market too much. So there's all of these considerations here. Maybe the Fed cuts by the end of the year once. I mean, the market is pricing 2 cuts. We still think that's a bit too much. But if with the recommendation that we would make to the Fed would be to stay the course, make sure that you react correctly to inflationary pressures. Inflationary pressures, if anything, they are about to accelerate. The labor market, it's not sending signals that it's filled with slack, so be careful with that again. So it's a very tough spot. So we'll hear what Mr. Powell says, and we will reassess next week. But it's a very tough spot in the market here. Could be disappointed by the message from the Fed, and we could have again a bout of volatility that comes from that over the next few days, weeks, months, for sure, as the market is trying to gauge exactly what the Fed will do. But here's what we think that it should do is to stay the course and wait some more before it goes with some rate cuts. So what we'll be watching next week in Canada, GDP for Q2. Q1 was very strong because of the front loading of inventories in the US. Q2 should be the payback for that, so it should be negative on the GDP. And in the US, we'll have lots of housing data. We'll have 2 consumer confidence data, stable or lower, depending on which measure. This is what's expected. And we'll have the inflationary measure that the Fed favors, the core PCE inflation. Month over month, 0.3% is expected, a bit high, and year over year, reacceleration to 2.9%. Again, not something that is screaming rate cuts here for sure. So that wraps it up for the week. Always a pleasure to serve you. If you appreciate the content here, please share, and also make sure that you come back again next week.